So how do you use life insurance as a bank? Well, is it even a bank in the first place? Well, let's talk about that right now. All right, so maybe you've heard about like infinite banking, the infinite banking concept that Nelson Nash had created, right? Maybe you've heard things about, using whole life as your own bank. Well, is it really a bank or not? I'm gonna kind of dispel some of these myths and talk about what it really is versus what it really isn't. Let's just hit this right now. Is this actual bank? No, you're not setting up your own bank. That is way harder than just setting up a life insurance policy. But what infinite banking is, the concept is, they're trying to get you to use your money to constantly cycle through. Just to understand that in general, even in economics, even with the markets and everything else, the way that people prosper more is how fast does money cycle, right? How fast does money go out and come back? It's just like this. If all of a sudden you went from getting paid every paycheck, let's say twice a month, to all of a sudden get paid the same amount weekly, you now make double the income and you're happy, right? More money's coming in, you can use that money faster, everything's faster in speed. That's what they're really meaning about this infinite bank, is that you're using this money, you can use the cash inside the policy. Now there's a death benefit. Yes, we get that with whole life insurance. But there's also this tax-free high yield savings account inside of this. So some of the money goes to insurance costs while the rest of the money goes into this account. Depending on how this is designed, more or less, you can actually design it to where less goes to insurance costs, more to the cash, although most don't do that. That's what you can do. And so when you have this cash, this tax-free savings account here, you can withdraw the money, or what you can do is you can get a line of credit from the insurance company. And yes, there are even banks that will do it too against your life insurance. They'll give you that line of credit. Most cases, usually at least 90-95% of the money is accessible to you with whatever is in there at that time. We actually set up for people where you actually have access to cash from day one, which is a huge benefit for a lot of people because it gets that peace of mind, that safety, knowing that they've got money accessible if they ever need it. Now, that money you can borrow from the insurance company. They will charge you interest, right? Just like the bank, they do charge you interest. But what's different, than like getting a line of credit from a bank, right? See, when you get a line of credit from a bank, and say it's a home equity line of credit, they charge you interest, but you're not necessarily earning interest on that money, are you? But inside the life insurance, you could withdraw the money, but if you withdraw the money out of your account, what happens is that whatever's in there, say you have $50,000 in there, you pull out $40,000, you're now down to $10,000. Now you're only earning interest on $10,000. Just like if you have a normal savings account. If you pull out all the cash, how much are you earning in interest? Nothing, right? Plus they don't pay you much anyways. They pay you like jack squat, but they really don't pay you a whole lot anyways. However, you can get a line of credit against your savings. Just so you know, you can do this at a normal bank, but the banks will pay you very little on the money versus what they charge you on the money. But insurance companies are much nicer to you when it comes to what they charge you. See, understand, like there's one insurance company that they'll say, we'll pay you 5.5%, but we'll charge you just over 6% for the loan. So their spread is maybe a little over 0.5%, 2/3% or something like that. That's the difference. Now someone might say, but why would I pay more to borrow the money? I might as well just withdraw the cash, shouldn't I? That's what I thought too. But here's the difference, and this is where it becomes like an infinite bank. The difference is this, and I don't mean infinite banking like using this to, just use this as a bill pay account. I mean, when you borrow this money, yes, you are borrowing it. Now, ideally, you're not just pulling the money out and then never paying it back. If you do that, the interest will compound against you. And at the same time, they're also compounding your interest in the account. So let's just say you had $100,000. You decide to borrow $50,000 from the insurance company, your full $100,000 is still in there. You didn't pull out your $100,000, it's still there, earning compounding tax-free interest. Now the $50,000 they are charging you interest on, but ideally if you're gonna pull out the $50,000, this is my recommendation, you use it for something that actually improves your cash flow situation. Maybe it's to pay off a credit card. If it can save several $100s a month, great. Take that payment that you saved on that credit card, use that money to pay back, to pay down that line of credit. Because as you pay it down, and just so you know, there's no minimum monthly payment, you pay it back however, whenever you want. Your deadline though for paying it back is your death. And that's because they know they're still paying you on the side over here. So usually it's kind of at a race, but if you're paying it back, even if it's just a little bit, even if it's just interest only, you keep the money from compounding against you. It stays at simple interest while they're paying you compounding interest, which is two different types of interest rates, two very different types. So this is why when they talk about this infinite banking strategy, where they say, instead of buying a car with cash, borrow from your policy to buy the car, and then the payment you would have paid to a bank, for example, if you would have got financing through a bank, use that payment to pay it back to the line of credit. Well, why do they say this? Now, a lot of them will lie to you saying, oh, you're paying yourself back interest. Bull. That's 100% bold-faced lie. You do not pay yourself back interest. You are paying interest to the insurance company. But what they're just saying is, instead of paying to the bank, pay back to them, because remember, you still have your money in here. It's still compounding and growing, so the spread on the interest rate is very, very low. But as you pay back that loan, it pays it down so that less and less gets charged in interest while they're paying you more and more in interest. You actually make a spread. You make a profit on the interest they pay you versus what you pay them as a result, if you pay back at least interest-only payments. That's the big if. So if you keep the money from compounding against you, the interest from compounding against you, the compounding interest they pay you will out-earn the interest they charge you. And that's what I mean when you can make money in two places at the same time. That's why some people talk about doing this as a bill pay account, because then you can pick up dollars here and there. Here's my personal perspective on this. Don't do anything that makes it so complex just to save 20 bucks in interest. It's not worth it, right? It's not worth having a part-time job trying to do this thing. And honestly, most insurance companies don't like it when you do it. There are actually insurance companies out there, big ones, that say, we do not support the strategy of using this as a bill pay account. So I will tell you this too, because from my experience, it's not worth the hassle. And it gets a lot of people buying a policy that's too big, has too heavy requirements for them. So if they can't pay it, they can't pay the premium, they lose the policy. Not a good thing. So I like when people buy a policy that actually meets their needs. It's very comfortable. It actually doesn't take much, if anything, out of their pocket than what they're already normally doing anyways. So it's almost like nothing more out of pocket than what they've been doing. So just understand that if you can use this to say, it could be to pay off debt, but even better to buy an investment or something like that, or invest in your own business if you're a business owner, where you can make returns and take the cash flow, the returns from that investment, come back and pay down your line of credit. Now you make a net profit here, and that money is still making you extra money there too. It's no different than if you had a savings account or a checking account, you drained it to go invest in something, and then you took the cash flow to replenish it again. You're doing the same thing, but you'll pick up thousands, if not hundreds of thousands of dollars more interest doing this strategy versus just using your own bank savings or checking. Now, here are some things that, another myth that I do not like. So I mentioned before that you can go and, some people will talk about buying their cars with it or their houses and things like that. Personally, I don't think that's a good option. And here's why. I love cheap bank money. To me, cheap bank money is less than 8% right now. If I can get a bank loan for about 8% or less, I'm gonna do that. So to give you an example, I bought a new car last year. Now I knew that interest rates were right around 7% or so on the car loans, but they offered me a 3.99% option. I said, awesome, fantastic. I will do that. Now I had more than enough money in savings and checking to pay that car out and cash outright. But I also know, because I'm an investor, I know that I can make way more money than 3.99% on my investments. So I said, yes, please give me that cheap money from the bank. So then I can use my own hard-earned money to go out and invest and make more money. So I love cheap money. This is why I get mortgages on my properties. Even my investment properties, I get mortgages on them because one, I know I'm writing off the interest anyways, but two, it's a low interest rate. Even if you say, 7%, 7.5% is not low, historically speaking, it's still pretty dang low. Now, see, I think that's better than getting like a 6.2% loan on my life insurance policy. Now, someone might say, well, if I had to pay 7.5%, why would I go for the 6.2% loan on the life insurance? And for me, it's simple, because that's my hard-earned money. I worked hard for that money, and I want that money to work harder for me. Yeah, I could save a little bit of interest, a teeny bit of interest by doing that, but now that hard-earned money is no longer work for me. It's just going to pay off what could be a loan. But if I can get bank money for cheap, this is why I get a mortgage for like 80 or 75% of the purchase price of that property, but then I use my Infinite Bank to then put as a down payment, because I cannot borrow that from the bank at cheap rates. I can't get it at all, actually. I'll use that for the cash. So when I have to use cash for something, I would rather use that money versus trying to pull it all out to throw into a property, and that's tied up. I can't get to that money. I want my money to work as hard for me in different places as possible. So that's what I do. I don't pull out money of my policy all the time. I'm not doing it on a daily or weekly basis. It might be at most once or twice a year I might use my policy. For the most part, here's how I'm using my policy. I'm letting my emergency cash store in there, because my wife wants to have several $100,000 sitting in the bank that we don't use. But the bank pays you jack squat, right? Right now, my credit union pays still 0.1%. Despite rates going up, they went from 0.05 to 0.1. They said, hey, we doubled the rate on you. You're welcome. And I said 0.1% is ridiculous, especially because I'll get taxed on that 0.1%. So I keep a little bit in the bank because I know I can go grab the money today. And I keep a little bit in my high yield savings account that I'm earning in the high threes right now. It came down from 4.5 down into the high threes. Thanks to interest rates. But now that's still taxable, right? I still have to pay tax on that money. But I have my life insurance that's paying me 6% tax-free. That's better than even most people get in CDs where they get taxed on their 5% returns or whatever they might get on the CD. I get it at 6% tax-free, no taxes taken out. So I keep the bulk of all of my savings in my life insurance, which is also a safe place to store because guess what? Lawsuits and creditors can't touch my money in there. The IRS can get to anything. They're the one people. But anybody else can't touch my money. I love that. I make more money and of course it's protected. It's tax-free, less taxes, less bills. I love it. So I like to use it for that. But then anything above and beyond that money, great, that could be used to go and invest. But again, I only do it for specific things where I know it's going to be a good cash flowing return, whether it be in my business or in my investments. And this is how the wealthy have used it. This is why banks have been using it as well. Banks have been loving it because I've actually known people that have owned banks refuse to put money in their own bank and instead put their money inside these policies because they know they have more control. They can get leverage from them. They can even get, by the way, banks, when they have bank-owned life insurance or BOLI, they get way more leverage out of these things. They can loan out 7 to 10 times the amount of money they have in their policies to get that they can then loan out and make money off of you. So that's one reason why they store so much money there. Wealthy have been using this for years as a great place to store money, great place to actually use it that when they pass on goes into their trust, and then that trust helps build their wealth from generation to generation rather than squandering it away from generation to generation. That whole family bank method. So anyways, I won't go into high depth with that. Just know there's a lot of great ways to use it that the wealthy have used, but you can still use it even if you're not wealthy. You can use it to actually help you increase and grow your wealth right now. All right, if you want to learn how you can actually do that, what does that look like in your situation? Go ahead and click to book a call below here.